Welcome back to the deep dive. Look, anyone involved in taxation and finance knows things move fast, right? Especially in dynamic places like the UAE. Staying on top isn't just smart, it's really essential. Today, we're cutting through some of that noise. There's a really critical update we need to talk about. Okay, let's unpack this. We're focusing on a very significant and very recent change to the UAE corporate tax law. It specifically concerns property. This comes from Ministerial Decision No 173 of 2025, just published July 24th. So brand new.
Exactly. And our mission today really is to explore what this actually means. How does this new ruling impact property as an investment? We need to look at everything from the accounting side to the direct tax implications. And this is crucial for your understanding for anyone building a financial strategy here. Okay, so when we talk about property, how it's treated for tax and accounting, it really depends on its use. And of course, UAE companies, they have to follow IFRS, International Financial Reporting Standards. There are two key ideas we need to keep in mind here. First, depreciation. That's basically recognizing that a physical asset loses value over its lifespan. Think maybe a 5-year life, and you charge a bit to your profit and loss each month. Then there's impairment. This is different. It's about looking at the asset's realizable value, what you could sell it for today. This can be, way higher than the original cost minus depreciation. Take a building bought in, say, DIFC back in 2009. Values were depressed then. Today, 2025, it's likely worth a lot more. Impairment captures that real-world change, unlike simple depreciation.
Right, so that distinction is pretty important for property. The main structure, the building itself, you'd look at impairment, maybe annually, but the things inside, like fixtures, fittings, those get depreciated monthly.
Precisely. That's generally how it works under IFRS.
Okay, so this flexibility, particularly around valuing the property itself, especially for those, large family-owned businesses or single-owner companies, which are a big part of the economy here. Well, it seems it led to a situation where, let's say, wise corporate tax planners could maybe use this to lower their tax bills quite a bit. What was the specific loophole this new decision is trying to close?
Well, what's fascinating here is how Ministerial Decision 173 tackles that head on. You're right. Previously, there was scope for companies to, shall we say, aggressively write down property values on their books. This created these large paper deductions. Over time, these could build up into effectively years and years of unused tax credits. They could then use these to pay much less tax than perhaps the spirit of the law intended. Now, Article 2, Section 1A of this new decision steps in and puts a hard cap on it. The annual deductible amount against corporate tax for investment property is now fixed at 4% of the original cost. So yes, you could definitely say this new rule closes that particular tax planning loophole quite firmly.
And this isn't just something for the future. It has teeth right now, doesn't it? The effective date is key. Article 7 says it applies from January 1st, 2025. That covers almost everyone already, right? So what does that mean practically? If your company took a tax benefit based on the old way after January 1st, and you've already filed your tax return, let's say your financial year was March 24 to Feb 25, and you filed in May, you actually must file an amendment now, is that right?
That's exactly right. An amendment is required. Our strong advice, contact the Federal Tax Authority directly. Get their specific guidance for your situation.
Okay, crucial advice. Now, just to be clear on what this applies to.
Yes, good point. It's very specific. This decision targets investment properties. Now, what's not included. It doesn't apply to, say, undeveloped land. Bare land is out. And, importantly, it also doesn't cover a company's own headquarters, the building they operate out of, even if it's some iconic tower. That falls under different rules, usually IAS 16 for owner-occupied property, not IAS 40, which covers investment property.
Got it. So the distinction is investment versus operational use, which means for you listening, if you're a corporate lawyer advising clients, if you're running a family office, or perhaps you're a high net worth individual with significant property investments in the UAE, well, it sounds like you have quite a bit to reconsider here regarding your strategies.
Absolutely. If we sort of step back and look at the bigger picture, this really marks a fundamental shift. We're moving away from a, let's say, more flexible, perhaps less consistently applied approach to property write-downs for tax, toward a very clear, standardized 4% cap based on original cost. It changes how property investment interacts with corporate tax here. It just does.
Exactly. And the UAE authorities have been pretty clear about the continuous evolution of their tax system. This feels like a very concrete example of that. So here's where it gets really interesting for you to think about. Given the specific move on property, what wider implications might it signal for adaptability and long-term investment planning? And maybe more pointedly, what other areas, what other asset classes might be next in line for this kind of regulatory deep dive and clarification? Something to ponder. Thank you for joining us on this deep dive today.